examine the market dynamics surrounding XRP, it becomes clear that its price formation is influenced by forces beyond the visible trading activity on exchanges. The statement that XRP price is being set behind closed doors is not an exaggeration, but rather a reflection of the complex interactions between institutional participants, financial infrastructure, and regulatory frameworks. Unlike purely speculative assets, XRP serves a functional purpose within the financial ecosystem, particularly as a bridge currency for cross-border payments and liquidity management. This functional utility places it squarely within the consideration sets of banks, multinational payment providers, and corporate treasuries who manage large volumes of capital and require reliable, efficient, and compliant solutions for moving money globally. Behind the scenes, these institutions engage in strategic positioning, evaluating market liquidity, operational efficiency, settlement speed, and regulatory alignment before making decisions that can influence the apparent market price. These processes occur across private channels, structured liquidity pools, and direct integrations with banking networks, which means that the flows and allocations that drive value are often invisible to the average retail observer. At the same time, systemic factors such as regulatory oversight, macroeconomic conditions, and integration with global payment infrastructure shape how institutions perceive risk, opportunity, and utility in holding or transacting with XRP. By understanding these mechanisms, it becomes apparent that XRP's price is not a simple reflection of supply and demand in public markets, but rather the outcome of methodical decision-making by sophisticated participants who are aligning operational, regulatory, and strategic considerations. This perspective allows for a more measured long-term view of XRP, focusing on structural and institutional realities rather than short-term speculation or market sentiment. It frames the discussion in terms of system evolution, adoption trends, and strategic positioning, providing a foundation for deeper analysis of how Wall Street and major financial actors engage with XRP behind closed doors. When we consider price formation behind closed doors, we are often referring to the interplay between market participants who have access to deeper layers of liquidity, advanced settlement networks, and bespoke financial instruments that are not immediately visible to retail investors. Large financial institutions, including multinational banks and liquidity providers, can coordinate or at least influence how XRP is allocated, transacted, and held across different jurisdictions, which indirectly informs the observable market price. This process is not necessarily conspiratorial, but it reflects the natural outcome of institutional mechanisms, where high-volume participants have disproportionate visibility and control over flows that are executed across multiple exchanges, private agreements, and settlement channels. As XRP is increasingly considered for use in facilitating cross-border payments, regulatory oversight becomes a critical factor. Jurisdictions like the United States, Europe, and parts of Asia have approached digital assets with varying degrees of scrutiny, and these regulatory frameworks influence not only how XRP is traded, but also how it is positioned by institutions in anticipation of compliance requirements. Financial institutions often prepare for potential shifts in regulation by structuring exposure through custodial arrangements, derivative contracts, or direct integration with payment systems. And these strategic moves can establish reference points for pricing that are not immediately visible in public market data. From a systemic perspective, XRP's price signals can be viewed as reflections of broader confidence in blockchain-based settlement solutions, efficiency improvements in cross-border payments, and anticipated adoption trends among corporate and banking clients. These factors, combined with macroeconomic conditions such as interest rates, monetary policy, and international trade flows, contribute to an environment where institutional positioning has tangible effects on the asset's valuation, even if retail participants cannot directly observe every transaction. The infrastructure supporting XRP, including liquidity pools, market-making algorithms, and direct bank integrations, further shapes the way supply and demand are expressed in the market. And these mechanisms operate continuously, often executing high-frequency decisions that stabilize or moderate price movements. When analysts discuss the concept of price being set behind closed doors, it is useful to recognize that this reflects a combination of strategic asset allocation, settlement optimization, and risk management by sophisticated participants rather than arbitrary price manipulation. Institutions are effectively calibrating the market based on anticipated demand from their clients, expected regulatory outcomes, and the operational capabilities of XRP as a bridge currency, which can create periods where market movements appear subdued or disconnected from retail trading activity. Over time, as adoption of XRP in financial infrastructure grows, these positioning strategies are likely to be increasingly informed by transparent performance metrics, integration success with correspondent banking networks, and demonstrable efficiency gains in liquidity management. This institutional lens also helps explain why XRP's trading patterns may differ from other digital assets that are primarily speculative. Because its value proposition is closely tied to tangible use cases in financial systems, and its price reflects confidence in its utility rather than solely sentiment-driven demand. Furthermore, cross-border payment corridors that utilize XRP allow institutions to reduce capital costs, improve settlement speed, and increase operational efficiency, and these improvements are monitored closely by Treasury departments, compliance teams, and financial strategists, all of which feed into positioning decisions. XRP's value proposition is deeply connected to its functional role within financial infrastructure, particularly in the realm of cross-border payments and liquidity management. Unlike many digital assets that primarily serve as speculative instruments, XRP was designed with a specific utility in mind to act as a bridge currency that can facilitate efficient movement of funds across different national currencies. This design has significant implicatio. NS for institutional behavior and long-term adoption, because banks, payment providers, and corporate treasuries evaluate the asset not simply on price trends, but on measurable performance and operational benefits. The ability to convert one currency to another rapidly and at lower cost is a tangible advantage for institutions, managing liquidity across multiple markets. In practice, this means that XRP is integrated into payment corridors where traditional banking systems may encounter friction, delays, or higher capital requirements. By using XRP as an intermediary, institutions can reduce settlement times from days to seconds, optimize capital usage, and lower transaction fees, which directly impacts operational efficiency. These advantages make XRP attractive to large-scale participants who prioritize predictable and reliable execution over speculative opportunities. Institutional positioning in XRP is often informed by pilot programs, strategic partnerships, and performance data that indicate how well the network can handle real-world payment volumes. Banks and liquidity providers tend to analyze throughput, transaction costs, reliability, and settlement speed before deciding the scale and timing of their exposure, creating a feedback loop where adoption decisions reinforce the perceived value of the asset. Furthermore, XRP's integration with financial infrastructure is not limited to immediate payment execution, but extends to treasury management and liquidity planning. By holding XRP in structured arrangements or custodial accounts, institutions can respond more flexibly to market demands, client transactions, and regulatory requirements. This operational alignment contributes to a stable framework where the asset's value is a reflection of its utility and not solely short-term market sentiment. Over time, as XRP continues to prove its effectiveness and streamlining, NG cross-border settlements, the adoption trend among banks and payment networks can accelerate, reinforcing the functional rationale for its use. This creates a scenario where pricing is indirectly influenced by institutional confidence in the asset's ability to deliver measurable benefits rather than by retail speculation. The long-term implication is that XRP's market behavior becomes increasingly correlated with broader adoption and integration within financial infrastructure rather than isolated trading patterns. In addition, the adoption process itself often follows a deliberate phased approach, where institutions test network performance, implement internal compliance checks, and gradually scale their usage based on results. This careful and methodical integration contributes to the perception of XRP as a utility-driven asset, reinforcing the idea that its price signals are, in part, reflective of underlying operational and strategic considerations. Ultimately, the combination of measurable utility in cross-border payments, efficient liquidity management, and systematic integration into financial infrastructure positions XRP differently from purely speculative digital assets, creating a market dynamic where institutional adoption drives both value and perception, shaping long-term positioning and stability in ways that are observable in professional financial analysis and decision-making. Regulatory frameworks and systemic factors play a critical role in shaping XRP's valuation, as institutions do not operate in isolation, but within a complex network of compliance requirements, macroeconomic conditions, and global financial infrastructure. For banks, payment providers, and other large participants, exposure to digital assets like XRP must be managed with careful consideration of regulatory oversight, which varies significantly across jurisdictions. In the United States, for example, legal clarity regarding the classification of digital assets, securities laws, and anti-money laundering requirements directly influences how institutions can hold, transfer, or utilize XRP. Similar considerations exist in Europe, Asia, and other regions where differing approaches to licensing, reporting, and operational standards require tailored strategies. Institutional positioning in XRP often reflects anticipatory moves, where financial actors assess potential regulatory changes and adjust their holdings or transaction strategies accordingly. These adjustments can include structuring transactions through compliant channels, utilizing custodial services that meet legal standards, or deploying hedging mechanisms to manage exposure. Such strategic behavior has a direct impact on observable market activity because institutions control large volumes of XRP, and their operational decisions influence liquidity, trading flows, and pricing trends, even if these processes occur behind the scenes. Beyond regulation, systemic infrastructure factors are equally significant. XRP's integration into cross-border payment networks, banking liquidity corridors, and settlement protocols means that its utility and value are linked to broader financial system efficiencies. Central banks, clearinghouses, and correspondent banking networks observe these integrations closely, as improvements in speed, cost, and capital efficiency can affect the competitive dynamics of international finance. Institutional actors take these systemic developments into account when positioning themselves because the adoption of XRP-enabled solutions can reduce operational friction, lower capital requirements, and enhance client service capabilities. Macro-level conditions such as interest rate environments, currency volatility, and trade flows also influence these decisions. For our example, periods of heightened currency volatility or restricted liquidity can increase the strategic value of bridge currency like XRP, prompting institutions to adjust allocations to manage risk and optimize settlement processes. Collectively, these regulatory, systemic, and macroeconomic factors create a framework in which XRP's price is shaped less by short-term sentiment and more by strategic considerations rooted in operational and compliance realities. Price signals that emerge in public markets are therefore partially reflective of careful planning, anticipated regulatory outcomes, and the efficiency gains achieved through network integration. This perspective highlights why XRP behaves differently from purely speculative assets. Its value reflects both its functional utility and the strategic calculations of sophisticated financial participants who navigate complex legal and systemic landscapes. Understanding XRP from this standpoint requires recognizing that institutions are constantly evaluating and adapting to evolving rules, infrastructure capabilities, and market conditions. Their positioning is informed not by hype or emotion, but by measured analysis of how regulatory trends, financial system integration, and macroeconomic variables intersect to affect the asset's practical use and strategic importance. Over time, as regulatory clarity improves and systemic adoption increases, these dynamics are likely to produce more predictable patterns in institutional behavior and consequently in XRP's market valuation. In essence, XRP's price is a signal not just of supply and demand, but of the ongoing alignment between regulatory compliance, systemic efficiency, and institutional strategy, offering a grounded and rational lens through which to interpret its market behavior.